Let me ask you something that I think about more often now than I did 50 years ago. If you had $140,000 and you knew this was the money that had to last you through retirement, that had to generate income, preserve your purchasing power, and be there for emergencies, how would you invest it? This is not a hypothetical question for millions of Americans over 65. This is their reality. And the advice they are getting from most financial advisors is, frankly, terrible. I have been investing for over 70 years. I have seen every market condition imaginable. I have made billions and I have lost billions. And I can tell you that the standard advice given to retirees, the advice to load up on bonds and dividend stocks and hope for the best, is designed more to protect advisors from liability than to actually build and preserve wealth for their clients. Today, I am going to share exactly how I would invest $140,000 if I were over 65 and building what I call a forever portfolio. This is not a portfolio designed to last 10 years or 20 years. This is a portfolio designed to last the rest of your life and potentially provide an inheritance for your children and grandchildren. More importantly, I am going to explain the principles behind each decision so you understand not just what to own, but why to own it. Let me take you back to 1965. I was 35 years old and I had just taken control of Berkshire Hathaway. The company was a struggling textile mill, and everyone thought I was crazy to invest in it. But I saw something others did not see. I saw a platform for building permanent wealth through ownership of great businesses. That insight has guided every investment decision I have made for the past 60 years. The same insight applies to your retirement portfolio. You are not just buying stocks and bonds. You are buying ownership stakes in businesses and loans to governments and corporations. When you think about it that way, the decisions become clearer. You want to own the best businesses in the world. You want to lend to the most creditworthy borrowers, and you want to do both at prices that make mathematical sense. The biggest mistake retirees make is thinking too short-term. They focus on generating income for this year or next year without considering what their portfolio needs to look like in 10 or 20 years. They buy bonds yielding 5% without considering that inflation might average 3%, leaving them with only 2% in real returns. They buy high dividend stocks without considering whether those dividends can be sustained through a recession. A forever portfolio is different. It is built to compound wealth over decades while generating enough income to live on. It is built to survive recessions, market crashes, and periods of high inflation. It is built to be simple enough that you do not need to monitor it constantly or make frequent changes. Once you set it up correctly, you can largely leave it alone and let time work in your favor. Let me walk you through exactly how I would allocate $140,000 for someone over 65 who needs this money to last forever. The first allocation is $50,000 to the Vanguard S&P 500 ETF. Ticker symbol VOO. This might surprise you because conventional wisdom says retirees should avoid stocks. That conventional wisdom is wrong. It is catastrophically wrong for anyone who might live another 20 or 30 years. Here is the reality that most advisors will not tell you. A 65-year-old in good health has a life expectancy of roughly 20 more years. Many will live to 90 or beyond over a 20-year period. Stocks have outperformed bonds in every single rolling period in modern market history. Not most periods. Every single period, the risk of owning stocks decreases dramatically as your time horizon extends. The S&P 500 represents ownership in the 500 largest and most successful companies in America. When you buy VOO, you own a piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, Johnson & Johnson, JP Morgan, and hundreds of other excellent businesses. These companies employ millions of people, generate trillions in revenue, and have survived every crisis the economy has thrown at them. The expense ratio on VOO is 0.03%. That means for every $10,000 you invest, you pay $3 per year in fees. This is essentially free access to the greatest wealth creation machine in human history. No advisor, no matter how smart, can reliably beat this index after fees over long periods. The data proves this conclusively. $50,000 in VOO will fluctuate in value. Some years it will drop 20 or 30%. This is normal and expected. But over 20 years, the historical average return of the S&P 500 has been roughly 10% annually, including dividends. At that rate, $50,000 grows to approximately $337,000 over 20 years. Even if you are withdrawing some money along the way, the growth potential is enormous. The key is not panicking during downturns. When the market dropped 50% in 2008 and 2009, the investors who sold locked in their losses permanently. The investors who held on and kept investing saw their portfolios recover within a few years and go on to new highs. Your job as a retiree is to have enough in safer investments that you never need to sell your stocks during a crash. The second allocation is $30,000 to the Schwab U.S. Dividend Equity ETF, ticker symbol SHI-D. This fund focuses on high-quality companies with strong track records of paying and increasing dividends. It provides income you can spend while also offering growth potential. SHI-D holds about 100 stocks selected based on financial strength, dividend growth history, and valuation. These are not speculative companies chasing growth at any cost. These are mature, profitable businesses that generate more cash than they need and return the excess to shareholders. The current dividend yield on SHG is roughly 3.5% on a $30,000 investment. That is approximately $1,050 per year in dividend income. And here is what makes dividend growth investing so powerful. The companies in SHG have been increasing their dividends consistently over time. Your income stream grows even if you never add another dollar to the investment. Consider what happens over 15 years if dividends grow at 7% annually, which is roughly the historical average for quality dividend stocks. Your initial $1,050 in annual income becomes approximately $2,900. You are earning almost triple the income without doing anything except holding your shares. This is the magic of dividend growth investing for retirees. The stocks in SHG are also less volatile than the broader market. They tend to hold up better during downturns because investors flock to stable, dividend-paying companies when times get tough. This provides some ballast for your portfolio during market turbulence. The third allocation is $25,000 to short-term Treasury bonds, specifically the iShares 0 to 3 month Treasury bond, ETF ticker symbol SCUV. This is your safety net. This is the money you can access without worrying about market conditions. Short-term treasuries are the safest investment in the world. They are backed by the full faith and credit of the United States government. They have essentially zero risk of default. And because they mature so quickly, they have almost no interest rate risk. When rates rise, you simply reinvest at the higher rates. Right now, SCUV is yielding over 4% on $25,000. That is roughly $1,000 per year in completely safe income. This income arrives monthly and can be used for living expenses or reinvested to compound further. The purpose of this allocation is twofold. First, it provides safe income that is not dependent on stock market conditions. Second, it provides a reserve you can draw from during market downturns, so you never have to sell your stock investments at depressed prices. This is crucial because the biggest mistake retirees make is being forced to sell stocks during crashes to meet living expenses. I recommend keeping roughly 2 years of living expenses in this safe bucket. If you need $20,000 per year beyond Social Security and other income sources, having $25,000 in short-term treasuries gives you more than a year of cushion. You can survive a market crash without touching your stocks. The fourth allocation is $20,000 to the Vanguard Intermediate Term Treasury ETF, ticker symbol VGIT. This provides higher income than short-term treasuries with moderate interest rate risk. VGIT holds treasury bonds maturing in 3 to 10 years. The yield is typically higher than short-term treasuries because you are accepting some interest rate risk. If rates rise, the value of these bonds will decline temporarily, but if you hold a maturity or hold the ETF long-term, you will earn the stated yield Currently, they get yields around 4%, similar to short-term treasuries. But when the Fed eventually cuts rates, which will happen during the next recession, intermediate-term bonds will appreciate in value. They provide a hedge against economic weakness that complements your stock holdings. $20,000 in VJIT generates roughly $800 per year in income. Combined with your other fixed income allocations, you have a substantial stream of safe income regardless of what stocks do. The fifth allocation is $15,000 to Berkshire Hathaway Class B shares, ticker symbol BRKB. I know this might seem self-serving, but let me explain why this makes sense independently of who manages the company. Berkshire Hathaway is not a typical stock. It is a diversified holding company that owns entire businesses across insurance, railroads, energy, manufacturing, and retail. It also holds a massive portfolio of publicly traded stocks, including Apple, American Express, Coca-Cola, and many others. When you buy Berkshire, you are buying a professionally managed, diversified portfolio with a 60-year track record of compounding capital. Berkshire has several characteristics that make it ideal for retirees. First, it is incredibly conservative financially. The company holds over $300 billion in cash and treasury bills. It can survive any economic crisis imaginable. Second, it pays no dividend, which means all returns come as capital gains that you can defer until you sell. This is more tax efficient than receiving dividends you might not need. Third, the company buys back shares when they are undervalued, which increases your ownership stake over time without any action required on your part. $15,000 in Berkshire gives you exposure to dozens of high-quality businesses through a single holding. It is diversification within diversification. And the track record speaks for itself. $1 invested in Berkshire in 1965 would be worth over $30,000 today, compared to roughly $300 for the S&P 500 over the same period. Now let me explain why this specific allocation works so well together. You have $50,000 in VOE for broad market exposure and long-term growth. You have $30,000 in SAG for dividend income and stability. You have $25,000 in SCUB for complete safety and liquidity. You have $20,000 in VJIT for income with some growth potential when rates fall. And you have $15,000 in Berkshire for professional management and diversified business ownership. The total income generation from this portfolio at current yields is approximately $4,000 per year, or roughly 2.9% of the total portfolio. This might seem low compared to what some advisors promise, but it is sustainable income from high-quality sources. It will grow over time as dividends increase. And as you reinvest income, you do not spend. More importantly, the growth potential of this portfolio is substantial. The $65,000 in stock investments, BOO, South Carolina HD, and Berkshire, will likely grow at 7 to 10% annually over long periods. Even with withdrawals for living expenses, the portfolio should maintain or increase its value over time. Let me walk through how this portfolio performs in different scenarios, because stress testing is essential for any retirement portfolio. In a normal year with modest stock gains and stable interest rates, your portfolio might return 5 to 7% overall. The stock portion contributes most of the gains. The bond portion provides steady income. You can withdraw 3 to 4% for living expenses and still see your portfolio grow. In a strong bull market year, your stock holdings might gain 15 to 20%. The bond portion returns at steady 4%. Your portfolio might grow 10% or more even after withdrawals. You can consider increasing your spending or simply let the gains compound. In a recession year with a bear market, your stock holdings might drop 20 to 30%. This is painful but expected. Your bond holdings remain stable or even appreciate as the Fed cuts rates. You draw living expenses from your treasury holdings without touching stocks. Within a few years, historically, the stocks recover and you have lost nothing permanent. This is why the allocation between stocks and bonds matters so much. The bond portion is not there to generate high returns. It is there to provide stability and liquidity, so you never have to sell stocks at the worst possible time. Most retirees get this wrong. They either own too many bonds and miss out on growth, or they own too many stocks and panic sell during downturns. The 35% allocation to stocks in this portfolio through VU, South Carolina HD, and Berkshire is appropriate for someone who needs the money to last 20 plus years. If you have other sources of income like Social Security or pensions that cover most of your expenses, you could potentially increase the stock allocation to 40 or even 50%. If you have health issues or expect a shorter time horizon, you might reduce it to 30%. Let me address some common objections to this approach because I know what the critics will say. Some will argue that retirees should own more bonds for safety. My response is that bonds are not actually safe for retirees with long time horizons. Bonds expose you to inflation risk, which is the risk that your purchasing power erodes over time. At 3% inflation, prices double every 24 years. If you are 65 and live to 90, you will need twice as much income at the end as at the beginning just to maintain your lifestyle. Only stocks reliably grow faster than inflation over long periods. Some will argue that $140,000 is not enough for retirement. They might be right depending on your lifestyle and other income sources. But the principles I am outlining work regardless of the amount. Whether you have $50,000 or $500,000 or $5 million, the same framework applies. Own great businesses for growth. Own treasury bonds for stability. Never sell stocks during crashes. Some will argue that you should pay an advisor to manage your money. For most retirees, this is a waste of money. Advisors typically charge 1% of assets annually on $140,000. That is $1,400 per year every year, regardless of performance over 20 years. You would pay $28,000 or more in fees. Money that would otherwise be compounding in your portfolio. The simple portfolio I have outlined requires no advisor and can be implemented in an afternoon. Some will argue that individual stocks would generate better returns. They might, but they probably will not. Study after study shows that individual investors underperform the market averages because they trade too much, make emotional decisions, and lack the expertise to analyze businesses properly. Index funds eliminate these problems by forcing you to own everything and hold forever. Let me talk about implementation because knowing what to do is only useful if you actually do it. If you are starting from cash, invest the full $140,000 immediately according to the allocation I described. Do not try to time the market by waiting for a better entry point. Time in the market beats timing the market over long periods. If you are starting from an existing portfolio of random stocks and funds, sell everything and reallocate. The tax implications might seem daunting, but holding a poorly constructed portfolio costs you more over time than paying taxes once to fix it. If you are in a retirement account like an IRA, there are no tax consequences to reallocating anyway. Set up automatic dividend reinvestment for all positions. The dividends from SHD and the income from SGov and Vigit should be automatically reinvested unless you need the cash for living expenses. This forces disciplined reinvestment and accelerates compounding. Check your portfolio once per quarter at most. More frequent monitoring leads to emotional decisions and unnecessary trading. As long as the basic allocation remains roughly in line with the target percentages, do nothing. Only rebalance annually if one allocation has drifted more than 5 percentage points from target. Do not watch financial news. It will only make you anxious and tempt you to do something foolish. The talking heads on television are paid to create drama, not to give good advice. Ignore them. When you need to withdraw money for living expenses, sell from the allocation that has grown the most. This naturally rebalances the portfolio toward your target allocation. In most years, you will sell from the stock portion because it grows fastest. In down years, you will sell from the bond portion because it holds value. Let me close by putting this in perspective. $140,000 is a meaningful sum of money. It represents years of work and sacrifice. It deserves to be treated with respect and invested wisely. The forever portfolio I have described is designed to honor that sacrifice by building wealth for the rest of your life. It is not exciting. It will not double your money next year, but it will compound steadily, generate growing income, and be there when you need it. Over 20 years, if history is any guide, this portfolio has the potential to grow to $300,000 or more while also providing income along the way. It can survive market crashes, recessions, and periods of high inflation. It can provide not just for your retirement, but potentially leave something for your children and grandchildren. The alternative is to do what most retirees do: chase yield in risky investments, pay excessive fees to advisors who underperform the market, make emotional decisions that lock in losses, slowly watch your purchasing power erode because you were too afraid to own stocks. I have spent 70 years learning how to build and preserve wealth. The forever portfolio I have shared with you today represents the distillation of everything I have learned. It is simple because simplicity works. It is boring because boring compounds. It is designed to last forever because that is how long you need your money to work for you. If you are over 65 with $140,000 to invest, this is how I would do it. $50,000 in VO, $30,000 in SCG, $25,000 in ZOV, $20,000 in VJIT, $15,000 in Berkshire. Then leave it alone and let time work its magic. That is the forever portfolio. That is how ordinary people build extraordinary wealth. And that is how you ensure that your money lasts not just through your retirement, but for generations to come. Now let me share some additional wisdom that comes from decades of watching retirees succeed and fail with their investments. Because the allocation I have described is only part of the equation. How you behave matters just as much as what you own. The greatest enemy of retiree wealth is not market crashes or inflation or high fees. It is fear. Fear that causes you to sell at the bottom. Fear that causes you to hoard cash earning nothing. Fear that causes you to listen to doomsday predictions and make radical changes to a portfolio that was working fine. I have watched people who had perfectly good investment plans abandon them at exactly the wrong moment. In March of 2009, at the absolute bottom of the financial crisis, I received letters from investors who wanted to sell everything and move to cash. They were terrified. The headlines were screaming about the end of the financial system. Every instinct told them to run. The investors who ran, who sold at the bottom, who moved to cash, they locked in their losses permanently. Many of them never recovered financially. The investors who stayed the course, who kept their forever portfolios intact, who maybe even added to their positions at depressed prices, they saw their wealth multiply many times over in the following years. Your forever portfolio is designed to make staying the course easier. The bond allocation gives you something stable to look at when stocks are crashing. The dividend income keeps flowing regardless of stock prices. The Treasury holdings provide absolute safety if you need cash. These features are not just about returns. They are about psychology. They are about making it possible for you to hold on when everything feels like it is falling apart. Let me talk about the role of Social Security in your retirement planning, because many people over 65 are making mistakes here as well. Social Security is the closest thing to a guaranteed inflation-adjusted income stream that exists. It adjusts for cost of living each year. It continues as long as you live. It cannot be outlived. For most retirees, maximizing Social Security should be a priority. If you can delay claiming Social Security until age 70, your benefit increases by roughly 8% for each year you delay past your full retirement age. That is a guaranteed 8% return with no risk. You cannot get that anywhere else. The forever portfolio I described can help bridge the gap between retirement and when you start claiming Social Security at the optimal time. If you are married, Coordinate your claiming strategy. One spouse might claim early while the other delays to maximize the survivor benefit. The details depend on your specific situation. But the point is that Social Security is too valuable to claim thoughtlessly. Take the time to optimize. The income from Social Security changes how you should think about your investment portfolio. If Social Security covers most of your basic expenses, you can afford to take more risk with your investments because you do not need them for essentials. You could potentially increase the stock allocation in your forever portfolio. If Social Security covers only a small portion of your expenses, you need more conservative allocations because you cannot afford large drawdowns. Let me also address healthcare costs because this is the wild card that destroys many retirement plans. Medicare covers a lot, but it does not cover everything. Dental, vision, hearing, and long-term care are largely uncovered. Prescription drug costs can be substantial. Supplemental insurance premiums add up. A major health event can still cost tens of thousands of dollars, even with Medicare coverage. I recommend keeping a dedicated health reserve outside of your forever portfolio. This might be $10,000 or $20,000 in a high-yield savings account specifically for medical expenses. This reserve prevents you from having to sell investments at inopportune times to pay for unexpected health costs. Long-term care is the biggest financial risk for retirees. Nursing home costs average over $100,000 per year in many states. A multi-year stay can completely deplete a lifetime of savings. Long-term care insurance is expensive and has its own problems, but it might be worth considering if you have assets to protect and family history of longevity. The forever portfolio can help fund long-term care if needed, but you should have a realistic understanding of the costs involved. If you have significant assets beyond the $140,000 we discussed, preserving some of that for potential long-term care needs is prudent. Let me discuss the emotional side of retirement investing, because the numbers only tell part of the story. Many retirees experience anxiety about their investments that has nothing to do with rational analysis. They grew up during times of economic hardship. They remember parents or grandparents who lost everything. They have an emotional relationship with money that makes them terrified of any risk. If this describes you, the forever portfolio can be adjusted to prioritize your peace of mind. You might allocate more to treasury bonds and less to stocks. The mathematical returns will be lower, but if it helps you sleep at night and prevents you from making panic decisions, the trade-off is worth it. The worst outcome is not earning lower returns. The worst outcome is making a catastrophic decision because you could not handle the stress. A slightly more conservative portfolio that you can actually stick with is far better than an aggressive portfolio that you abandon at the first sign of trouble. Conversely, some retirees become too focused on leaving a large inheritance. They live like paupers, denying themselves enjoyment, so they can leave more to their children. This is often misguided. Your children would probably rather see you enjoy your retirement than receive a larger inheritance. Spend some of your money on experiences that bring you joy. Travel while you can. Help your grandchildren while you are alive to see their gratitude. The forever portfolio is designed to grow, but that growth serves no purpose if you never enjoy any of it. Let me share some thoughts on working with family members because money issues destroy more families than almost any other factor. Be transparent with your spouse about your finances. Both partners should understand the forever portfolio, know how to access it, and agree on the withdrawal strategy. Too many retirees leave a surviving spouse confused and vulnerable because they kept all the financial details to themselves. Consider having a conversation with your adult children about your plans. You do not need to disclose exact amounts, but letting them know that you have a plan, that your finances are in order, and what you expect from them can prevent misunderstandings later. If you plan to leave an inheritance, let them know. If you plan to spend most of your money on your own care, let them know that too. If you want to help children or grandchildren financially during your lifetime, be thoughtful about it. Gifts are often more appreciated and useful when you are alive to see them enjoyed, but do not give so much that you jeopardize your own security. Put on your own oxygen mask before helping others. Estate planning is beyond the scope of this discussion, but make sure you have a will, powers of attorney for health care and finances, and beneficiary designations that match your intentions. The Forever portfolio can transfer smoothly to heirs if your estate documents are in order. It becomes a nightmare if they are not. Let me return to the specific investments in the Forever portfolio and explain a few more details that matter for implementation. When you buy VOO, you are buying the exact same stocks in the exact same proportions as the S&P 500 index. The fund is so large and liquid that you can buy or sell any amount at essentially no cost beyond the tiny expense ratio. It is the default choice for U.S. stock market exposure, and there is no reason to look for alternatives. When you buy SHD, you are getting a rules-based approach to dividend investing. The fund screens for companies with at least 10 years of dividend payments, strong balance sheets, and attractive valuations. It rebalances quarterly to maintain these standards. You do not need to analyze individual dividend stocks because the fund does that work for you systematically. When you buy SCOV, you are getting the absolute safest investment available. The Treasury bills in this fund are backed by the full faith and credit of the United States government. The average maturity is so short that interest rate movements have almost no impact on the fund's value. This is where you keep money you absolutely cannot afford to lose. When you buy VOGIT, you are accepting moderate interest rate risk in exchange for the potential for capital gains when rates fall. This fund has more price volatility than SCOV, but also more upside. It serves as a hedge against economic weakness because Treasury bond prices typically rise when the stock market falls. When you buy Berkshire Hathaway, you are getting a permanent holding that requires no maintenance. The company has no plans to change its structure, pay dividends, or do anything that would require decisions on your part. You simply hold the shares and let the company's retained earnings compound on your behalf. It is the ultimate set and forget investment. The total number of holdings in this Forever portfolio is 5. You could implement it in less than an hour using any discount brokerage. There are no complex strategies to execute, no options or derivatives, no frequent trading required. Simplicity is a feature, not a bug. I want to address one final topic that I think about often. What happens to your money when you are no longer able to manage it yourself? Cognitive decline is a reality for many people as they age. Even if you are sharp at 65, you might not be at 85. The Forever portfolio is designed to be simple enough that a trusted family member or professional could manage it on your behalf if needed. There are no complex strategies that require expertise. Just hold the 5 funds and rebalance occasionally. Consider naming a trusted person as your financial power of attorney. Make sure they understand your investment philosophy and your wishes. Leave written instructions about the Forever portfolio so they know not to make radical changes. The simplicity of this approach is protective because it reduces the opportunities for mistakes by whoever takes over. If you do not have anyone you trust to manage your money, consider establishing a relationship with a fee-only financial advisor who can step in if needed. Fee only means they charge a flat fee or hourly rate rather than a percentage of assets. This removes the conflict of interest that commission-based advisors have. The Forever portfolio is not just for you. It is for everyone who might need to manage your money someday. By keeping it simple and well documented, you protect yourself and you protect them. $140,000 invested wisely can support a dignified retirement. It can grow to provide an inheritance for your children. It can weather the storms that inevitably come. The Forever portfolio I have described is my best thinking on how to accomplish all of these goals simultaneously. You do not need to be a financial expert. You do not need to spend hours researching investments. You do not need to pay expensive advisors. You just need to implement this simple plan and then have the discipline to leave it alone through good times and bad. That discipline is the hard part. Everything else is easy. But if you can master the discipline, if you can ignore the noise and stick to the plan, your financial future is secure. That is the promise of the Forever Portfolio. That is the promise I am making to everyone over 65 who has worked hard, saved diligently, and deserves a retirement free from financial worry.